This week, Alphabet, the parent company of Google, reports its second quarter 2026 earnings. This is not just a story about one company. Google's results are one of the most important economic indicators available to any investor. Today, I'm breaking down exactly what to watch and why it matters to your money, even if you have never bought a single Google share. Why Google's earnings matter beyond Google itself. Google controls approximately 90% of global internet search. Its advertising revenue is directly tied to how much money businesses are willing to spend to reach customers. When businesses are confident and growing, they spend more on advertising. When they are scared and cutting costs, advertising is the first budget to fall. Google's ad revenue is therefore a real-time indicator of global business confidence. What analysts are expecting this quarter. Analysts expect Alphabet to report earnings of $2.90 per share, up 25.5% year-on-year on revenue of $116.9 billion, representing 21.3% growth. These are extraordinary numbers for a company of Google's size. For context, $116.09 billion in a single quarter is more than the annual GDP of many countries. The AI question that dominates everything. Google is simultaneously one of the largest funders of AI infrastructure and one of the companies most threatened by AI disruption to its core search business. OpenAI's ChatGPT and similar tools are changing how people find information, potentially reducing the number of Google searches performed every day. If AI reduces search volume, Google's advertising revenue faces a structural threat, regardless of how well the broader AI investment pays off. The cloud business as the growth story. Google Cloud is the number 3 cloud provider globally behind Amazon and Microsoft. It has been growing at over 25% annually. Cloud revenue is recurring, high margin, and directly tied to AI infrastructure demand. Strong cloud numbers this week would offset any concern about search disruption. What S&P 500 earnings growth of 23.6% in Q2 tells us. This is the second consecutive quarter of earnings growth above 20%. For the S&P 500, the economy is performing significantly better than the pessimistic headlines suggest. Strong earnings growth is the most important support for stock market valuations. When companies are genuinely earning more, higher stock prices are justified. This earnings season so far is showing real strength beneath the geopolitical noise.